When Fed policymakers meet tomorrow, they will undoubtedly discuss last Friday's jobs report showing that payrolls fell by 131,000 and the unemployment rate remained unchanged at 9.5%. This raises the question, what can or should the Fed do now to invigorate a sluggish job market and the economy? We debate the jobs picture and the Fed's response now with two economists. Allen Sinai is the president of consulting firm Decision Economics. He's followed the economy for more than 40 years and says the Fed and Congress need to take action to boost the jobs market. Brian Wesbury joins us as well, chief economist at First Trust Portfolios, an investment firm. He doesn't agree. He says the jobs market isn't so bad since the work week and average hourly earnings are rising. Gentlemen, thanks for joining us. Brian, I have to, after saying that, ask you first, I mean, how could you say it's not so bad? We lost 8 million jobs. The U6 number is even worse than the U2 number, 16 or 17%. Sure. It seems like it'd be pretty horrible, especially if you're one of those people who's out of a job.
Yeah, and it is, Matt, and I don't disagree that that things have been better than they are right now in the past. However, things are getting better today. We've had about 90,000 new jobs per month on average so far this year. That goes all the way back to January. Even last month in July, we created 71,000 private sector jobs. The work week, the length of the work week went up. Average hourly earnings went up. So when I look at all of that, I see a recovery happening. It's not the greatest recovery or the fastest recovery we've ever seen, but it's better today than it was a year ago.
You know, Alan, Brian makes a good point. Maybe it's not as strong as we had hoped, but it's certainly a lot better than it was 12 months ago.
Oh, it's certainly better than it was 12 months ago. It could hardly have been worse, but it's terrible. I think we have at 9.5% unemployment rate. And ex-census, I think, is the way to look at last month, plus 12 and the month before plus 4. And a real dislike of hiring by American business because labor is so costly. That was in your last segment. We really have a tremendous economic, societal and political problem with that unemployment rate. It's going to stay sticky high. I don't think companies are going to change their spots. What we see is kind of what we're going to get for easily another year, another jobless recovery.
Yeah, you know, I'm not sure I agree with that. I think we will see an acceleration in jobs, but kind of let me come in there. So all right, we have a high unemployment rate. We've got a workforce that feels bad. We've got companies that are nervous. What's the answer? Because, you know, in my opinion, the answer that we've given, let's just cut interest rates to zero. Let's throw all the money of our children and grandchildren and run up these deficits and try to stimulate the economy. It hasn't worked. In fact, it's worked backwards. It's destimulated the economy. Nothing's worked like we have been told that it would. So I think what we need to do is stop all of this stuff and let the private sector bring this economy back, not keep trying to use the government to do it.
Hey, you know what? We talked to Jeremy Siegel earlier from Wharton. Listen to what he had to say.
Even though they're making good money, they're holding on to that money. That money will eventually be used either for dividends, share buybacks, or, as I believe, expand the workplace.
Alan, don't you? I mean, this is the argument we hear from a lot of people. They've made so much money, and then, of course, they put that money to work buying machines, buying software, you could say, so that they can use fewer people, but eventually they need people to come in and start using this stuff, especially when sales finally pick up.
Yeah, not on a growth rate of 2.5%, at most 3%. The growth rate isn't high enough to generate enough expectation of sales in the U.S. for companies, plus all the uncertainty of the elections and what's going to happen, for companies to step out and buy more. So all they're doing is basically spending money on capital goods to substitute for labor. Where I really agree with Brian is what he said about policy. It has been wrong-headed, particularly fiscal policy. The answer clearly now, though surely things could have been worse. That's history. But look where we are now. What do we do going forward? The outlay-driven fiscal policy that has created huge deficits has not bought us very much in the jobs market, and that's where we are now. Right. We would have been better off doing tax cuts than doing project-driven kinds of federal outlays. It's not the federal government that creates jobs, it's the private sector.
And Brian, that's kind of a good point. We've had a fair amount of guests come on and talk about the importance in terms of corporate tax policy to really kind of induce corporations to go out and eventually hire workers. That could be a very significant policy. Don't you at least concede that maybe we need a policy like that coming from the government?
Sure. Well, it all depends on what kind of corporate tax policy you're talking about there. I believed in just cutting the corporate tax rate and letting corporations decide how to grow their companies and make them more competitive with international companies. So, for example, Canada right now has, in fact, in the past couple of years, cut their corporate tax rate from 19.5 down to 18. They went to 18 this year from 19 last year. Percent, and ours is 35%. By the way, Canada's unemployment rate is 8%, ours is 9.5%, and they've actually seen a boom in their economy, much stronger than ours in the last couple of years. So, yes, I think that we ought to look at corporate tax rates, but I think we ought to just not try to give them kind of stipends for hiring people, but just let their tax rates go lower and make them more competitive, and that'll bring more hiring to the United States.
What do you think, Alan? I mean, you have kind of from what I read, a sort of redistributing view on taxes here, but you don't want to raise capital gains taxes. What do you think about corporate taxes?
Our corporate tax rates are way too high compared with other countries. We're not competitive internationally on that. They do need to be lowered. I think the cost of labor is so high, not the wage component, but things like pension funds, healthcare costs, Social Security. So we need to reduce taxes there. The problem is, where do we get the revenues? You get the revenues by slowing the growth of federal government spending and raising taxes elsewhere. So tax hikes that don't hurt the economy as much as tax cuts, depending where you put them, help the economy, would be a budget-neutral way to go. It's a tough problem.
Do you think you get the revenue, Alan, from raising taxes on the rich? Because a lot of studies show they just put their money in other places. I
think if the Bush tax cuts expire for the high-income families, it's about $300 billion over a certain number of years. We should take those revenues and cut taxes permanently for middle and lower-income families. They'll spend more, or use some of them to cut corporate taxes. That's a budget-neutral activity. We'll get more growth. We'll get more jobs from that, and we will get some tax receipts ex post after the fact that will come back to the government, and the deficit will get better.
All right, we do have to run, gentlemen. Allen Sinai, Brian Wesbury, thank you so much. We appreciate your time this afternoon.